Hello, my name is Charlie Jordan. I'm the practice area leader for Retiring Well here at Brightworth, and I want to thank you for watching this video today. Today we're going to be talking about the Biden tax plan and your retirement. So there's currently a proposal in front of Congress that has come out of the House Ways and Means Committee. What are the major provisions of that, and how does it affect your retirement? But before we get started, I have just a couple of very important disclaimers I want to mention here. First is the items here are just proposals. This is not law. This has simply come out of committee. It has not gone to the chamber for debate yet. So we are still in the very early stages of this process. But it's important to know sort of what Congress is thinking and what the initial proposal is going to be. In fact, there's some speculation there's been a considerable amount of negotiation already take place with this, since this is a very streamlined version of what the original Biden tax plan was at the beginning of the year. So what we're looking at right now, again, is just a proposal. It is simply an indication of the starting point for the debate and negotiation inside of Congress. Second, this is general in nature. This is not specific to your situation. I don't know everyone's personal financial plan here, nor could I. And the information and the planning considerations contained inside this conversation today are meant for informational purposes. They're meant to bring you up to speed on what's going on in the political realm and what's happening as far as the legislation is concerned. But any planning consideration should be done within the context of your own specific financial plan and with, hopefully, the help of an advisor. So let's take a look at our agenda for today. There's three main areas that we're going to be focusing on with this proposal: income tax changes, retirement account changes, and estate and gift tax changes. We'll also look at a couple of planning considerations that we might want to keep on the radar as this legislation continues to unfold. So when it comes to income taxes themselves, what's really changing here primarily is the rates. There's a lot of different provisions of this proposal that get into corporate taxes, that get into some minutia of some situations that aren't going to be as relevant, especially to retirees. But there's two areas that we want to focus on with this change. One is the marginal rate, and then we'll talk about the capital gains rate here in just a moment. The marginal rate, the biggest change, is going to be at the top level. So it'll increase the top marginal rate to 39.6%. This is changing from 37 where it is currently. You might be thinking that's not that big a change, a couple of percentage points at the very top end. You're right in that, but what we're going to look at here is what it does to the 35% bracket in just a bit. There's also two numbers I want you to take a look at here. It's the $400,000 single and the $450,000 married filing joint. These are two important milestone numbers for taxable income, and they're going to be used throughout the legislation for different changes that you're going to see. The big thing here is the marginal rates are effective for the 2022 tax year. Okay, so let's take a look at the actual brackets and some of the changes that we see in the proposal. I'm going to focus on the married filing jointly side. So if you see the current brackets, if you go all the way down, you'll notice that the 35% bracket starts at $418,000 of taxable income and ends at $628,000 of taxable income. Everything over and above $628,301 is taxed at 37%. What the proposal does is move that top bracket to 39.6%, completely gets rid of the 37% bracket. But look at the 35% bracket. It again starts at $418,851, but ends at that $450,000 taxable income number. That gap between $628,300 and $450,000 is a major shift for folks who are going to be making over $450,000 of taxable income. Now, I realize that that's not going to be the case for most retirees, but for those who have had a big year, say you have a business sale, or you have stock option exercises, or some major income year, you could be faced with seeing significant increase in the top end of that bracket over time. So let's take a look now at the capital gains, which is the other major change in the brackets themselves and the rates themselves. The increase of the top long-term capital gain rate to 25% from 20% currently. Now, again, this applies to those $400,000 and $450,000 taxable income magical numbers there. One of the big caveats in this is that this applies to any sales on or after September 14th of this year, not next year. So we are already in a place where capital gains at the top end brackets are going to be taxed at a higher level. Again, where this really applies for most people is going to be in a major income year, like a business sale, oftentimes triggering a bunch of capital gains. You could have a situation where someone has a significant amount of capital gains that are applied in 2021 that now have an extra 5% of tax applied to them with really no option for planning. One of the things that we've been looking at with potential tax legislation all along was, would it be retroactive to this year? And as the years progressed, the thinking had been, no, they're not going to make it retroactive for this year. They're going to make it effective for 2022. That is the case for marginal rates. It's not the case for the change in capital gains rates. But let's just make one thing really clear here. The two areas we've looked at for income tax changes have been marginal rates and capital gain rates, and they've both been for taxable incomes over $400,000 and $450,000 respectively, single or married filing joint. So while there is a major tax increase taking place for those folks over that level, for most Americans, most retirees, this is not changing their taxes. Now, there's a whole debate on how corporate taxes get passed along to the consumers. We're not going to get into that today. That's a whole other conversation. But from a purely rate standpoint, it's very clear that this proposal is showing if you make under $400,000 single, $450,000 married filing joint, you're unlikely to see much change in your taxes from a rate standpoint. I think that's really, really important. One area to look at is a small provision around wash sale rules. Now, if you're not familiar with wash sale rules, this basically says if I sell an asset at a loss, and I have a tax loss that I'd like to claim, I can't go buy back that same asset within 30 days. So I can't sell Apple stock today, take a loss, and buy it back tomorrow, the same position, and still be able to claim that loss. I can buy it back if I want to, but that tax loss now goes away. And what's important to recognize is they're closing the gap on a couple areas with the wash sale. They're really expanding it to all related parties, including spouses, dependents, retirement accounts, which is a really big one, and trusts. So if you have a related party involved, you can't sell at a tax loss and buy back that same security within 30 days and still be able to claim the capital loss on your taxes. Where this also applies in an area that hasn't had this application so far has been cryptocurrencies. So currently, if you had Bitcoin and you sold Bitcoin today at a loss, which many people have done, and you could buy it back an hour later if you wanted to and still be able to claim that tax loss. This is going to change here in 2022 with this wash sale rule change. So cryptocurrencies will have the wash sale rules applied to them starting next year. All right, let's talk about retirement accounts. Again, what's important to note here is who this applies to. So two things that you want to take a look at here is high income, those magical numbers again, 400, 450, and combined balances of all retirement accounts, IRAs, 401ks, etc., exceed $10 million. If that's the case, you're going to have a required minimum distribution due for 50% of what's over $10 million. If you read between the lines, what's happening here is they don't want massive IRAs or 401ks or retirement accounts that are tax deferred to have large balances. They're kind of declaring here $10 million is my large balance level. Now there's provisions in here what happens if you have over $20 million. We're not going to get into that today. But the key to understand here is for retirement account changes is primarily going to be for those with high income and aggregate balances over $10 million. Typically, to get to a $10 million IRA, you probably have had to have inherited some over time. Those are pretty large balances, or you had to be right place, right time, and get those numbers up substantially high. It's possible, but you don't see as many $10 million plus IRAs as you do other types of accounts. So this might apply to you, and if it does, you're going to have a required distribution take place on what you have over $10 million. Now let's take a look at the estate and gift tax changes. This is something that's been a major speculation into this year, and a lot of people have done a lot of estate planning work already in anticipation of what ultimately is you hear about the exemption going down. The technical word for that exemption is the unified credit. It is $5.85 million per person in this proposal. Technically, it's $5 million plus several years worth of cost of living adjustments. It's roughly half of what it currently is today. Now, what does that mean? That means that you can pass $5.85 million per person to a non-spouse beneficiary and not have any estate tax. Now, there's a lot of different rules around taxable gifts during lifetime, etc. We're not going to get into that today, but generally, if you have $10 to $11 million or less, you're not going to have an estate tax bill if you were to pass away, if both you and your spouse, if married, were to pass away. Now, that's important to know kind of where the line is. A lot of speculation on where that line was going to be made. Was it going to be 3.5? Was it going to be 5? Was it going to be any other number in between? Basically, they landed at the $5.85 million roughly. Okay. Now, for people who have $20 million plus, this now represents a significant potential issue from an estate tax standpoint. And there's some strategies that they need to potentially employ with the help of their attorney to make sure that they're taking advantage of the current unified credit and also making sure that they're not putting themselves in a position to have to owe estate taxes if they were to pass away. So there's a lot of estates that have been established with more of a $20 to $22 million exemption mindset that now need to shift back to what does it look like if I have assets that are over, say, $11 million. There's other strategies that are going to be tweaked or eliminated as a part of this proposal if this legislation passes. One is defective grantor trust. I'm not going to get into that today, but bottom line is if that's a strategy that you are looking to employ, they're not going to exist after this year if this legislation passes. And the other thing is family limited partnerships, which has also been something that a lot of people have used to reduce their taxable estate. The discounting process of utilizing family limited partnerships is going to be limited. And so that's something that will also affect many people who've employed some of these strategies or are looking to employ those going forward. So let's go ahead and talk about a couple of planning considerations in light of these changes. I guess the first thing is start with a financial plan. Let's know your situation. Let's understand what your needs really are. Do you even have a tax issue here? There's so many people who are just not going to have a major tax problem, especially those who are in retirement already. I think where people really need to understand how this is going to affect them is if they have a major transition that includes a lot of economics in this year or next year. Are you selling a business? Are you exercising a lot of stock options? Are you doing something that's going to create a lot of potential taxable income? And if so, how is that going to impact you one year versus another? And is there something you might consider doing? Would it be good for you to accelerate income into this year and not recognize it next year with the higher tax brackets? That's something to consider. The other thing you mentioned, we mentioned the wash sale rules with cryptocurrencies. If you have a loss in a cryptocurrency, considering selling it this year, go ahead and claiming that tax loss. You can buy back that same security the next day. Take advantage of the rule as it exists currently, because that will be changing in 2022 potentially. Another way to take a look at reducing your taxable income could be to gift assets to charity. Best way to do that is gifting highly appreciated assets to charity. When you do that, you're gifting the embedded capital gain tax liability to charity as well, and that's going to reduce both your marginal income tax plus your future capital gain tax. So a good sort of bang for your buck in reducing your taxable income, both current and future, is to gift assets to charity, and using highly appreciated securities, often in the context of a donor advised fund, are ways to do that really well. From an estate standpoint, I can't stress this enough. If you have a taxable estate of $10 million or more, you should be talking to your estate attorney now. These attorneys are going to be very busy. If you know an estate attorney, keep them in your thoughts and prayers over the next several months. They're going to be busy. But if you have a taxable estate, $10 million or more, and you have not done any kind of planning to be prepared for a world in which the exemption is now $5.85 million roughly per person, you need to talk to your attorney real quickly. There might be some things that we want to do in this tax year. There may not, but we want to make sure that your estate is set up in a way that can take advantage of the laws in the best possible way and be as flexible as possible. But if you wait too long, you're not going to be able to get in front of the attorneys that you want to get in front of. So if you have an estate attorney, I'd call them up today and say, do I need to talk to you or not? If you don't have an estate attorney, let us know. We'd be happy to make a recommendation for you, or at least give you a list of names. All right, next is just ways that you can utilize your larger unified credit this year versus next year. So right now, your unified credit is almost double what it's going to be if this legislation passes. Can we utilize some of that this year through gifts to trust or gifts to family members, etc.? That's something that you'll want to do, again, within the context of working with your estate attorney. And then lastly, one of these areas that you could do at any time, it doesn't really have anything to do with this proposal necessarily, but it's a great way to reduce potential taxable income because of required minimum distributions that you have, is to use something called a qualified charitable distribution with your IRA that allow you to gift money directly from your IRA to a charity if you're over 70, and be able to do that and reduce how much taxable income you have to claim because you're not taking that money in. So whatever you're passing to charity is not coming in as taxable income. Might be a way to help you massage some of those brackets if you need to. Well, I hope this video has been helpful for you. We would love an opportunity to talk to you about your specific situation. If you'd like to do that, you can email us at retiringwell@brightworth.com. You'll also see in the end of the video ways that you can connect with us on social media and see our latest content on our website at Retiring Well. Hope you have a wonderful day. Take care.